rejoin, eh? Okay, now we can begin. I was saying that, of course, in some circumstances, you may find the some businesses do not have proper state of records. You find that maybe some records were destroyed, or because they do not have someone experienced to keep proper records or books of accounts, or somebody who is manning the books has no knowledge, meaning that it doesn't record transactions in the way they are supposed to be recorded, okay? Hence making single entry. So when single entry occurs, it means that the business transactions are recorded without following the duality concept or double entry system of recording. I believe when you're looking at fundamentals, you must have looked at the duality concept, that in accounting, every transaction must be recorded twice. Okay, so meaning that if the double entry system is not followed, then it means that you've made a single entry. So with single debit entry is not corresponded with the credit entry. So meaning that if it is not, then you find that the records are not, of course, complete. Now, when we talk of incomplete records, they occur when the business does not have a full set of all the required accounts. And when we talk of a full set of accounts, we are talking of source documents like invoices and receipts, primary books like sales journal, purchases journal, returns journal, ledgers, that is both general and subsidiary ledgers, okay? Then we also have trial balance, financial statements. So that means that all those, of course, will not be available. So an organization with single entries and incomplete records will be faced with difficulty in extracting the trial balance and also preparing financial statements. So as somebody who has got some knowledge, okay, you have some knowledge in accounting, then you should be able to look at the available documents and assemble them together so that you can come up with a complete set of financial statements. Now, why do organizations have single entries and incomplete records? What brings it? Number one, we said if the person hired does not have knowledge, okay, somebody maintaining the books of accounts does not have knowledge, of course, you'll have such kind of single entries. Then also, if you find that you have inadequate accounting staff, you find that the inadequate and maybe the work is too much, you find that most of the transactions, the books will not be maintained properly. Then also, where you have small business owners, especially not appreciating the value and role of accounting. So you find that you have a business, yes, but you really feel like hiring maybe somebody experienced to maintain your books of accounts is a little bit costly, and you don't take much value in that. Then also records, especially in disaster. Consider the prudence, please. You're interrupting my class. So I think loss of records, especially if there is maybe a disaster like fire outbreak, floods, okay? Or it is even deliberately done with the intention to defraud the business. See, some people may ban the offices, the records, especially if they want to conceal evidence. Okay, that means that you need to reassemble the information together. Also, another reason where you find that the law may not be forceful. For example, the Companies Act only forces limited companies file their annual accounts with the register of companies. And of course, this does not apply to partnerships and then trading. Okay, all those, of course, could lead to single entry and incomplete records. Of course, there are a number of disadvantages of having single entries and incomplete records. One of them is lack of proper books of accounts. And of course, this normally misleads in planning and also in decision making. Also, when there is poor tax assessment, leads to poor tax assessment. You find that if you do not have records, ideally when the taxman comes and maybe the taxman estimates you could end up paying a higher tax than what you would have paid, especially if you had proper records. Also, accessing loans becomes difficult because you know that sometimes when you go to some of these commercial banks, they will request you to provide your audited accounts maybe for the last 3 years. So it is going to be a little bit difficult if you do not have records. So it becomes hard for you to access loans or credit from the commercial banks. Then also determining it is very difficult in determining the performance of the organization, financial performance and position. Because if you've not prepared the statement of profit or loss, it will be hard for you to know the performance of your organization. If you've not prepared the statement of financial position, it will be hard for you to know the worth of your business. Of course, there are a number of disadvantages, but of course, what I give you is just a guide, meaning that you should look for more. Okay. Now, sources of information for correcting single entries and incomplete records. So if there is, you've been hired, you find that the business has got records which are incomplete. Okay, the business has got. You find that maybe the person in charge of manning books of accounts has been making single entries. Okay, so what are some of the sources of information of correcting these single entries and incomplete records? Of course, you can get information from any of the following. Number one, from receipts that have been issued to customers or received from suppliers and other those utility suppliers. Maybe you can look at National Water, Umeme, okay? Maybe you can get bank statement, because ideally you find that most organizations operate through bank accounts. So mean that there are very few rare cases of cash transactions. So if you get a bank statement, then you can always trace the payments that were made and maybe the receipts that came in. Okay. Then also you can get information from invoices issued against credit sales and received on credit purchases, especially to track your debtors and creditors. Then you can also decide to carry out stock taking, physical counting of stock, and maybe verifying assets which are in existence. Then you can also make an interview and discussion with business owners. Okay, so those are some of the sources of information. Because someone may ask you to explain the sources of information for collecting single entries and the corporate records. Of course, those are some of the key issues that I would expect from you. Now, guidelines for preparing financial statements from single entries and the corporate records. Number one, preparing the performance of the organization. You need to prepare an income statement or statement of profit or loss. Okay, statement of profit or loss, and other comprehensive income. Okay, that is one which you can prepare to determine the financial performance. And when I talk of financial performance here, I mean the profitability of an organization. And it is from this statement of profit or loss that you would be able to determine whether the organization has made a profit or loss. So in situations of single entries and incomplete records, you can determine the net profit in two ways, basing on the accounting equation, which I believe you still recall, which you did in the fundamentals of accounting 1. Okay. Then you can also prepare the income statement. Okay. Now, if you are to determine the net profit basing on the accounting equation, okay, of course, you know the accounting equation is that assets is equal to liabilities plus owner's equity. So meaning that if from owner's equity, you can always determine the closing capital, okay? Because if you get the opening capital and you add any additional fresh capital that has been introduced in the business, and you also add the net profit, then you list the drawings that would give you the closing capital. So basically, the net profit would be closing capital plus drawings minus any opening capital. Now you have this example here. Pero, sole trader on National Street in Kampala, had his business capital balance of 8 million at the beginning of 1st of January 20X2. During the year, 31st December, the gentleman added 4 million to the existing business so as to expand his capital base. In October 2012, he withdrew 1 million from the business to entertain his friends. On 31st December 20X2, Mr. Okero had 12.5 as his capital balance. So they're saying that you determine the net profit for the year ended 31st December. So for you to determine the net profit, if you get the closing capital of this gentleman, which is 12.5, you raise the opening capital of 8M. You also raise the additional capital that this gentleman introduced in the business, and you add drawings of 1 million, you should be able to get your net profit. Okay. Now, then you can also determine the net profit by preparing the statement of profit or loss. Okay. But of course, to use this method, there are various steps which are normally followed. First, correct the mistakes made when the accounts are prepared in single entries, and of course, when some accounting records are missing. Step number 1 is that you need to prepare the statement of affairs at the beginning of the financial period. And this step is necessary, especially when there is need to determine the value of opening capital at the beginning of the financial period. So in other words, if you've not been given opening capital, then you can prepare the statement of affairs. And of course, that of affairs would enable you to determine the opening balance of what? Of capital. So when you talk of statement of affairs, it is just a summary of assets, less liabilities, and of course, builds from the accounting formula. Assets minus liabilities is equal to capital. When you get what the business the assets of the business minus what the business owes others, then you should get the capital of the business. Then you can prepare also a cash book. I believe when you are looking at fundamentals, you also must have looked at a cash book. Okay, the different types of cash book, 2-column, 3-column. Okay, and of course, when you prepare each, so you can prepare a cash book, and of course, with a cash book, it will help you determine your cash receipts and payments. Okay, and it is mainly done to establish both the cash and bank balances at the end of the year, and sometimes calculate the value of drawings. Then step 3 is that you need to determine sales and purchases. And in this case, credit sales and credit purchases can be determined either using control accounts. I don't know whether you looked at control accounts in fundamentals. Okay. So you can either use control accounts, the debtors control account, and then the creditors control account. Okay. Or you can use the margin and markup to determine the value of credit sales and credit purchases. We have an example here, okay, that requires us to use debtors and creditors control account. I don't know whether you're still on board. Are you on board? Hello? Hello?
Yes.
Yes.
Are you getting me?
We are.
Yes.
Yes,
You are
we
too
do.
fast.
Sorry?
You are too fast.
Katongore, you are right. You see, the good thing is that this is a recorded session. In case you don't get something, you can always go back and view the recorded version. I'm going to upload actually this first one and second one. By end of today, all of them are going to be uploaded on Moodle, so that you can. I think the first one was for financial management, and because this is our first lecture for intermediate. Because the other first one were just in the introduction. Now, let's do this example. Now, when I talk of control accounts, did you cover control accounts in fundamentals?
No.
Abunya, did you cover control accounts?
No, sir.
One.
You did not.
Yes.
Yes.
Okay. Now, you see, organizations always, most companies sell on credit. They purchase on credit. And of course, you find that if you've sold on credit, there are different people who have taken your goods on credit. You have different debtors, and you also have different creditors. And you find that each debtor or each creditor has got an individual ledger account. That is in your books of what? Accounts. But in most cases, if you want to monitor, you want to basically establish how much is outstanding to your creditors and how much is due from your debtors. You need to prepare one account so that you are able to track all your credit sales, or you're able to track all your credit purchases. Because if you have got individual ledger accounts, yes, it's very important. But in some cases, it becomes hard for you to know how much is outstanding and how much is due from your debtors. So that's why it is always necessary to prepare one control account so that you are able to track all your credit sales and credit purchases. And there are two types of control accounts. We have the debtors control account, and then we also have the creditors control account. Now, when you look at this example, they are saying that we should determine the figure for credit sales. Now, if I'm to draw my ledger account here, let me draw my ledger account. This is my debtors control account. Debtors control account. Okay. And the debtors control account, you can say this tracks debtors control account. You can put here maybe the debtors control account tracks all sales made on credit. Okay. So meaning that if I have my debtors control account here, I have my debtors control account. Okay. I have been given this illustration. I have the opening balance of debtors as 140 million. And then I have the closing balance as 130 million. And you know that debtors have the opening balance, of course, will appear on the debit side. Why? Because if they are debtors, those are current assets. And you all know that the normal balance for assets is a debit balance. So my opening balance, my balance brought down here is 140 million. Okay. Then when I come to my balance carried down, my balance carried down is 130 million. Okay? That is my balance carried down. Now, when you check, you have these other items. You have bad debts that have been written off. Okay? Now, if bad debts have been written off, it means that you are going to debit bad debts expense account, and the corresponding credit would be here in the debtors control account, because now you are reducing your debtors. And when I say a debt being written off, you know basically what it means. It means that you have completely lost hope in recovering that money from that particular debtor. So I will have my bad debts written off, bad debts, and the amount for bad debts is 3.4 million. Okay? Then you have cash received from debtors. Now, if debtors paid you, what does it imply? That you're going to debit cash and then you credit the debtors account. So I'll come here, I have cash. So they have paid 780 million. This is what they have paid. Okay, they have paid 780. The debtors have paid 780. Now you have returns inwards. Okay, now if you had sold on credit and you expected to get that money from debtors and they have returned back the goods that they have taken on credit, then it means that you no longer expect that money because your goods have been brought back. What are you going to do with this money? I will credit my debtors. Yes, please.
Well, after debiting cash in the debtors control account, we said we credit debtors in the cash account.
No, I have credited my debtors control account with 780. The corresponding debit will be in cash account. The corresponding debit will be in cash, because if the debtors have paid you, what does it imply? That the balance has reduced. What you expected to get from them, it has reduced. Okay? Like you pay, you have your data in your books. If he pays, what do you do? Don't you credit his account and then debit bank or cash, depending on the method of payment?
Thank you, sir.
Okay. Now, so now returns. So I will credit my debtors control account with 5.7, and of course the corresponding debit will be in the returns inwards account. Then you have discount allowed. So if you allowed a discount to your debtors, then that means that ideally, and you know discount allowed is an expense. So the debtors account is going to reduce and you will debit the discount allowed expense. So I will have discount allowed. So this is 15 million. Okay. So having this now, I can balance off my ledger account. If I balance off my ledger account, the balancing figure would be basically the figure for credit what? credit sales. Okay, so if I add, I don't know whether you have your calculators. As you come on 9 days, you also need to ensure that at least you come with your calculator. So you can balance off for me this ledger. Balance the ledger. Which side is bigger? Which side is bigger? I am waiting for you to give me. I see the credit side is bigger. What is the total? Nobody has a calculator. 780 plus 3.4 plus 5.7 plus 15 plus 130. That gives me 934, 100. So to get 934, 100, my balancing figure would be what?
Uh, 794, 100.
So my credit sales, would be 7 what?
794, 100.
94, 100. That is my figure for credit sales. Okay, it is exactly what I was trying to do. What to determine. Okay, my figure for credit sales is 794, 100. Okay, so that is using debtors control account. Now there is example number 2. Example number 2. From the following information, determine the figure for credit purchases. Okay, I have shown you. Now, if you are done credit purchases, of course, now you are going to prepare the debtors, the creditors control account. So my creditors control account creditors control account Now, this creditors control account, of course, I can say it tracks credit purchases. I say that this creditors control account tracks all purchases made on credit. Okay, tracks purchases made on credit. So I also have the opening balance here for creditors. I also have the closing balance And you know that creditors, of course, their liabilities, current liabilities. And from your understanding of double entry in year one, you must have been told that all liabilities, the normal balance is a credit what? Balance. So meaning that my opening balance will be on the credit side. My balance brought down would be 80 million. Okay? Balance brought down will be 80 million. Then balance carried down will be 75 million. Okay? So that is my opening and closing balance. Then you have discount received. Now, when you talk of discount received, of course, discount received, you know, it is an income. Okay? So if you have received a discount from your creditors, I will debit the creditor's control account, and the corresponding credit will be in the discount received account. Okay? So I have discount received. Because if they give you a discount, ideally it means that what you are supposed to pay them now has reduced. So this is 14 million. Okay? 14M. Then you have returns outwards. Now, you know, returns outward also reduce the creditor's balance because you had purchased items on credit, but maybe these items are not exactly what you had ordered for. So the implication is that you're going to debit the creditor's control account with returns outwards, which is 12.5. And the corresponding credit will be in the returns outwards account. Bank payments creditors. So if you have paid, you will credit the bank and the creditor's account will be debited. So here I have bank. Okay? I paid them 500 million. So if you balance off this account, if you balance off this account, if you balance off this account, which side is bigger? I see the credit side was 14 plus 12.5 plus 500 million plus 75. So that gives me 601 500. So to get 601 500, what is the balancing figure? So the balancing figure represents credit purchases. What is the balancing figure?
521,500,000.
521 what?
521,500.
Like this.
Okay.
So that is the figure for credit what? Purchase. Because these control accounts are very, very much important, especially if you have not been given the figure for sales and purchases. Later on, as we shall see in the comprehensive numbers. Okay. So this is my figure for credit purchases. Okay. So that is one way you can use a control accounts to determine these two figures: credit sales and credit purchases. Now, you can also determine sales and purchases using gross profit markup or gross profit what? Margin. So you can use these two depending on the information. You see, with single entry, if you are to do to do this number, you need to look at the available information, because you may find that the available information may not require you to use accounts. Okay? And maybe you have been given the markup and the margin. So you can also use this, the gross profit markup and margin, to determine your credit sales and credit purchases. So the gross profit markup and margin are used to determine the cost of sales, the figure for which is later used to determine credit sales and purchases. And when you talk of gross profit margin percentage, this is normally expressed as the percentage of cost of sales. Then markup is expressed as a percentage of cost of sales. Okay, so meaning that if you have this markup margin, you can determine your credit sales and credit purchases. Now, you have an illustration here. You've been given the opening stock, and you also have the closing stock, you have the gross profit, and then you have the markup. So they are saying that given the following information, determine the value of cost of sales. Okay. You also determine the value of purchases, and you also determine the value of sales. These are the three figures I want you to determine. Okay. Determine cost of sales, determine purchases, determine the sales. Okay. I have opening stock given to me, closing stock given to me, gross profit given to me, markup also given to me. So now, you know that the markup is equal to gross profit over cost of sales. Okay, and I know that my markup in this case I know it is 25%, which is 0.25. Okay, and this will equal to gross profit, which I know as 20 million, over cost of sales, which I don't know, over COS, which I don't know. Because markup is equal to gross profit of cost of sales. Okay. Now, from this, if you cross multiply, okay, by cross multiplying you will have 0.25, okay? Cost of sales is equal to 20 million. So now, if I divide this by 0.25, I also divide this by 0.25. Okay? What would be my cost of sales?
80 million.
Cost of sales will equal 80 million. That is my figure for cost of sales. I don't know whether you have all seen how I have gotten the cost of sales. Okay? Is it okay? Okay. Now, I have determined the cost of sales. Now, I need purchases. Okay? I need purchases. I need purchases. Let me just take it to the next page. Now, so I've determined the cost of sales. So what I need now purchases. But now, for purchases, you know that if I have the cost of sales, I know that my cost of sales is equal to opening stock. I add purchases. I raise closing stock. Opening stock, and I have this variable. I have this one. I have this one, but what I don't have is this. This is what I'm looking for now, the red one. Okay, cost of sales, I've already known it is 80 million. Opening stock is given to me as 3 million. P, I don't have P, what I'm looking for. Then I raise closing stock is given to me as 5 million. Okay? Sorry, I had lost my connection. I don't know. Are you able to get me now? Okay, so I think I'm back online. Let me share again. So I was determining purchases, and I say that if you have cost of sales, if you already have cost of sales, and you know that cost of sales is composed of opening stock, add the purchases, less the closing, you should be able to get this P. Because these other variables, at least you know them. You know your cost of sales as 80. You have your opening stock at 3. You don't know P, but you know the closing stock as 5. So meaning that if you collect the right terms, you should be able to get your purchases. So what is the purchases figure? Yes? What is the figure for purchases? Hello?
Hello.
82 million.
Eh? How much?
82 million. 82.
So this is the figure for purchases. Okay? This is the figure for purchases. So that is example number 1. Of course, we have not finished. We need to determine the sales. Now, what about for sales? Okay, sales. Now to get sales, I know that sales minus cost of sales equal to gross profit. Okay, I already know this variable. I also know this, but I don't know S. So S minus POS, which is 80 million. But I know at least that one is equal to gross profit. I think gross profit have been given the figure of gross profit as 20 million. So gross profit is 20. So if I collect the right terms, then I should be able to get my sales figure. So mean that S, okay, is equal to 80 million plus 20 million, which is equal to 100. That is my figure for. I figure for sales. Okay, my figure for sales is 100 what? Million. Now, so I think that one is okay. Is it okay? Hello? Are you on board? Are you still on board?
Yes, it is, sir.
Okay. Now let's go look at example 2 for today, and then because later on we're going to look at if you look at some of the comprehensive numbers, what we are going through is that it will help us do some of these comprehensive numbers, because when you look at them, most of the information, you find that it is not really straightforward. You have to assemble it. And these are some of the methods that, of course, we are using, the ones that we're going through now, which will help you determine some of the missing figures, especially when we come to comprehensive numbers. Now, we have another example of David. David owns a shop in Arua. He had stock in trade on 1st of July 20x7. And then they're saying that this stock was valued at 8.4. And when the stock taking exercise was carried out, it indicated that he had stock valued at 9.35. That is at the end of the year. Okay. Sales for the year ended June 30th, 20x8 amounted to 80 million. And the business makes a gross profit margin of 25%. So what were the purchases during the year? You recall that in the previous example, we're looking at markup. Now, in this second one, we've been given a margin. And you say that the gross profit margin is expressed as a percentage of sales. So if I have my margin, okay, according to GP of S of now sales, because margin we say that is expressed as a percentage of sales. Markup expressed as a percentage of cost of sales. And I already know my margin as 25%, which is 0.25, equaling to the gross profit. I don't have the gross profit this time, okay? So this is my GP of S of sales, okay? So meaning that if I cross multiply, do I have the gross profit in this scenario? I only have the sales, okay? I think I have the sales. Sales for the year amounted to 80 million. So the only unknown variable here is now the gross profit. So if I cross multiplying, okay, by cross multiplying my gross profit, okay, will be what? 0.25 times 80 million. Okay? Times 80 million is equal to gross profit. So what is the gross profit then? So your GP is what? Give me the figure. That's when I'm going to
20 million.
Is 20 million. That is my gross profit. Okay? Now, but of course they're asking for purchases. Okay? So meaning that let me take this to a different page so that I have enough space to view the figures. So if my gross profit is 20 million, so what does it imply? Okay. My gross profit. Now for purchases, for cost of sales rather, Okay. So are you able to see my screen?
Yes.
Yes, sir.
Okay. So I was saying that for cost of sales, now, to get my cost of sales, I know that cost of sales, if I have sales minus cost of sales minus COS is equal to GP. So what do I have? I have my sales. The sales is 80. You see here? Sales here, they are saying it is 80 million. Okay? They say it is 80. I erase cost of sales, which I don't know. The gross profit is given now. I've done it as 20 million.
20 million.
Okay? So meaning that my cost of sales, I can be able to determine the cost of sales. So meaning that 80 million, okay, minus 20 million equal to cost of sales. So meaning that my cost of sales will equal to 60 million. I think you have seen how I've determined my cost of sales. The cost of sales is now for purchases. How am I going to get my purchases? My purchases, I know that if I get the cost of sales is equal to opening stock add purchases less closing stock. Okay? And I already have my cost of sales as 60 million. Purchase opening stock is, when I check in my illustration here, opening stock is valued at 8.4. That is the opening stock. I add 8.4. Then I add the purchases figure, which I don't know. Because this one I don't know. It's what I'm looking for. Then I erase closing stock, which is given in the scenario here as 9,350. Okay? Closing stock, 9,350. 9,350. So I should be able to determine, because now I have all the other variables are known. The only variable which is not known is P. So I should be able to determine my P. So if I collect the right terms together, I will have 60 million minus 8.4. Then I add 9,350. So we're equal to P. So what would be my purchases? The purchases would be, because you know that if this one crosses the equal signs, it becomes a negative. If this one is a negative, if it crosses, it becomes a positive. So what is my P?
60,950,000.
60 million
950,000.
950,000. So that is the figure for purchases. Okay, this is my figure for purchases. Now, step number 4 is to determine if you have any accruals and prepayments. You need to have your T accounts so that you basically
Excuse me, sir.
yes.
Excuse me. Before you go to the
Yes.
next step, I would like to ask. Before you go to the next step, I'd like to ask: is gross profit margin the same as markup?
No. Because you said margin is expressed as a percentage of what? Sales. Markup, it is expressed as a percentage of what? Cost of
sales.
Cost of sales. Totally different.
Okay.
Okay.
Okay. Thank you.
Yes, please.
I'm still not understanding the difference between cost of sales and sales. It's a matter of I think it's a matter of English. I don't understand the difference between sales
No,
and
it's not a matter. Sales, that is basically, if you define sales, the items that you sell and the intention, okay, was basically to sell those items. Like you have sold an item, and that item maybe was basically held with the purpose of selling it. That qualifies to be a sale. Any item which you sell and it was basically held for the purpose of sale qualifies to be a sale. And when you talk of cost of sales, cost of sales, cost of sales is basically the cost incurred in the items that you had bought with the intention to do what? To resell those items. And this cost of sales is composed of opening stock. Okay? You add purchases. Okay? And then you less closing stock. Okay? That would give you your cost of sales. So that if you get your cost of sales, you net it off from the sales, it will give you your gross profit. So the two are different. Sales is what you derive from the items that you've sold. And those items were basically held with the intention to sell them. You had bought them, but the purpose was to resell those items so that you get the profit. Cost of sales is the cost you incur in getting those items. Okay, well, the cost you incur in making the sales. And we say it is composed of opening stock, add purchases, and you know there are items which affect purchases. If there are any returns outwards, of course it will affect the purchases figure. I don't know whether that one is clear.
Yes, it is. Thank you.
Now,
yes, it is. Thanks so.
So the next step which I will give you a task. I want you to do for me this illustration. Have the T account so that you analyze exactly how much was paid especially where you have prepayments and accruals, you need to prepare the T accounts. And then you also do this example of team. But when we meet, we shall basically be looking at a comprehensive example. Like there are so many review questions at the end. So we shall look at a comprehensive number, and then you do the rest of the numbers. And you know, this time exams are going to be done physically, not online. If you are used to take home, if you don't prepare, then that means at the end you have nothing to write the exam, because it is going to be closed now. So you have been used to online, but this time it's going to change. The exam is going to be physical. Okay, so you need to tell your colleagues who think, even if I don't attend online, I will get somebody to do for me the paper. It will be very bad for you if you come, you sit. Someone is saying, sir, please send the notes after the lecture. These notes were sent. Didn't I send the notes? Don't you have the notes on single entry?
We have them.
Yes. Hmm?
It's there.
So we meet tomorrow for financial management. We are meeting at what time? What time are we meeting?
After lunch.
At 11.
At 2 tomorrow. I think we are meeting at 2.
Yeah, at
We shall meet for FM tomorrow at 2. And I will be posting notes that we're going to look at in tomorrow's session. Because I believe you've met Ninye. He must have taken you through time value of money. So tomorrow we shall be looking at our next topic, which I will upload on the e-learning platform by close of day today. And the recorded sessions, I will also upload them on the platform so that you can always go back and view them. Otherwise, bye-bye for today. See you tomorrow. You are free to leave.